Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, I'm going to get into something that I've been really excited to talk about. Why your investment returns are not great. And I'll give you a hint, it has nothing to do with fees. But before we get into today's episode, the free advice for the week that does pertain to this episode. The money is not made in the actions that you take, but the waiting once the action has occurred. Now, I want you to marinate on that for a little second before we get into today's episode on why your investment returns are not great. And again, even the titling of this episode, when you read it, you're like, oh, that's kind of defeating. I don't want to hear that my investment returns aren't that great. And some of you might not even want to listen to this and say, well, I don't need to know why. No, you really, really do. Like, it's okay to take ownership on the fact that you may need to improve in an area or two in your life. And investment returns is kind of a big deal. Now, in order to give you a clear-cut picture on why your investment returns are not great, I'm not just going to be spitballing all of this. I actually am going off of my most recent research into this topic, which was based on several articles I read through Morningstar, which, for those of you that are not aware, Morningstar is one of the largest independent, completely, unaffiliated to the rest of the world research conglomerates in the world of really just money in general, investments in financial planning. And actually, I got to give a shout out to my first episode and guest ever, Dr. David Blanchett. He's no longer at Morningstar, but at the time he was the head of Morningstar Research. And some of his research articles have been paramount to what I do and has set the foundation for capitalizing on people's finances. So got to give credit where credit is due, especially to Dr. David Blanchett. Miss you, buddy. So with that, what were some of the key takeaways? Let's just start from the get-go. What were some of the key takeaways that I took from a lot of this research? So Morningstar's research highlighted the danger of chasing returns. And what were some of the dangers? This or what consisted of that? Frequent trading was a big one, and that often led to lower real-world results for investors. Another takeaway was simplicity and automation can help investors capture more of their investments' total returns. And then the last one, and we'll get into all of this more in depth as the episode goes along, the findings actually challenged the long-held belief that risk and reward always move together, which is very fascinating. Because you've heard the term high risk, high reward. Not always the case. Sometimes you're taking a lot of risk and there's really no reward to be had. On the flip side, and I've actually said this in the past, sometimes the easiest returns to have are the best returns you're going to get. So we'll talk about that more as the episode progresses. So the first thing I want to talk about is the investment performance gap. And what is the performance gap? It's the return differential between what a lot of people are getting or certain indexes, as an example, versus what the average investor gets. So Morningstar did some research over the past decade, which ended December 31st of 2024. And over that decade, investors, so everyday people, missed about 15% of total returns from the United States investments due to poor timing and trading behavior. And this is by investments, we're talking like within funds. Now, these funds, which again, a lot of people like to knock actively managed investments, like mutual funds, because they say, oh, just invest in the index and you're going to beat absolutely everyone. That can be true, but in fact, the top money managers out there and the best out there, those funds earned about 8.2% per year, but the average investor earned only 7%, a 1.2% annual gap. That doesn't sound like a lot of return loss. You're probably thinking like, well, what's the big deal? It's a big deal over time. It adds up. And that 1.2 difference, really, I mean, the way I look at it is you're actually compounding yourself at a significant loss, and you didn't have to. Now, why do investors underperform? Why do most people underperform? We talked about this earlier in the summary, chasing returns. Most people, and I would say most people, even in my industry, on top of everyone outside of the industry, most people tend to buy after strong performance. So basically the return has already been made, and you're looking at, and this is the classic, past performance does not guarantee future returns. I am obligated to say that, one, regulatorily, but then two, just based on common sense. The past can be a strong indication of what could happen in the future, but you can't guarantee it. You cannot guarantee it. And a lot of people treat these past investments returns as that guarantee, which is completely inappropriate and it's imprudent. So you buy after all the performance has actually been made, and then you're selling when the market dips, and that's a whole other can of rabbit hole of wrong. But the main thing that you need to take away from that is just because the market is down, or more specifically, just because your investments are down due to just valuation fluctuations, that does not mean it's a bad investment. In some cases, that should mean you should maybe load up on it. Again, I'm not giving specific investment advice, but just don't think of these things as just surface level absolutes. Think deeper. Think deeper about your money. Another reason why investors underperformed, and this was in the study, but like I've kind of known this for a while, is people trade too often. And we've spoken about this a ton on the show in the past. The greatest investment you can guarantee other than in yourself is not a natural investment. It's the taxes you avoid. Period. No questions asked. Well, the more you trade, and again, specifically in taxable accounts, because retirement accounts, there's no tax consequence until you take the money out. So the more people trade in their non-retirement accounts, the less their funds and them themselves, their return they capture. So, again, I'm not saying taxes are the end all be all, but that's a really easy one, all things being equal, to go, hey, if I need to hold on a little bit longer so I'm not taxed year after year after year, then don't trade. Like it's really that simple. Now, the last reason investors underperform, because we talked about chasing returns, we talked about trading too often, and those are pretty black and white. Like once I've explained that, I'm thinking the majority of you out there are going to go, yeah, that tracks. This one's a little bit more ambiguous, but I could make a strong argument it is more important than the other two that I mentioned combined, which is behavioral finance traps. So yes, buying high and selling low, it's a recipe for underperformance. And I don't want to sound like I'm just kind of like bobbing in and out of not telling you the absolute truth of what you need to know with this. But with behavioral finance, there's a lot of psychology and subconscious, like within you, that you just need to figure out why you are wired the way that you are. And I know that just sounds like, okay, Chris, you just said a lot of nothing. So I'll try to be a little bit more specific on that. Let's say that for whatever reason, you go through, you've written your plan, you go, hey, I need market exposure. So I need to be invested in the stock market, and I'm more of a mutual fund guy, but my friends are individual stock people. So because I'm drawn to that because they've had really good performance recently, I'm going to go and try to convert my subconscious behavioral finance tilt to more of an individual stock person, but I really should be in the lane of mutual funds. Well, by doing that, again, you're setting yourself up and you're trying to put a square peg into a round hole, and you don't have to. Like, people need to understand when it comes to the stock market, yes, Technically, it does matter how you invest, whether it's a stock portfolio, index or ETFs or mutual funds. I get it. But for the majority of you out there, you need to figure out what flavor works best for you and then just do it. And the best example I use is, and there aren't really Baskin Robbins around here, but like, okay, let's say you're into Ben & Jerry's. Okay. So you go into a Ben & Jerry's store. Not that there really is anything around here, but if you did. So let's say there's you and two buddies. Let's say you are into vanilla. Your buddy A is into strawberry ice cream and your buddy B is into chocolate ice cream. Well, you all go into Ben & Jerry's, you get different flavors, but you're coming out and you're getting basically the same amount of calories. Some of you may have a little bit more than others. You're getting the same, breakdown of nutrition or lack thereof nutritional value. But the point is you're all eating ice cream and you're all going to be happy at the end of it. It's the same thing with the market. Some of you may be more mutual fund inclined. Some may be more index fund or ETF fund inclined, technical term. Some people may be more stock portfolio inclined. Stick to what behavioral, financially related works best for you. Hopefully that clears that up a little bit more. So what is the solution to getting over a lot of your underperformance? Now, the really easy answer is just say, stay the course, but there's more to it than that. So we've obviously covered that investors who trade less and automate routine tasks like rebalancing their portfolio capture more of their portfolio, or if they're in investments, their funds' total returns. But I want to explain that a little bit more because automating and keeping it simple, yes, it removes emotional decision-making. It can be kind of a set it and forget it. And set it and forget it sounds so great. It sounds so great. I want to caution you, though, be intentional with your trades. So I want you to think about timing. No, you can't time the market, but you can time certain things. And unfortunately, with compliance, I can't get too much more in depth with that. But think about timing. Think about the necessity and think about the purpose of why you're doing it before you trade. Automation is phenomenal. Rebalancing is phenomenal until it's not. Before we go into the commercial break, I'll leave you with this. A lot of people think that money is a very fixed asset. And if you've listened to the show for years, I've brought up this type of concept. Money is not a fixed asset. Different monies work differently. Like a stock works differently than cash. Cash works differently than an equity index annuity. An equity index annuity works different than a real estate investment trust, which works different than private equity. They all work differently. So money is not a fixed asset. It is very dynamic. So what I encourage you to do, both during this episode, as you continue to listen after this award-winning commercial break, as well as after this episode, is I want you to convert your fixed mentality with money to being dynamically nimble in the mind when it comes to your money and understanding how all these things relate, whether that's listening to more episodes, buying my book, Capitalize Your Finances, going online, hitting up my masterclass on capitalizepodcast.com. Like there's all of these tools that I'm giving you out there and they're not expensive. So figure out one of them and just do it. But by doing that and putting just a little bit of effort into reinvesting in the betterment of your financial well-being, you are going to have greater returns. And it doesn't necessarily mean investment returns, but, and again, I can't guarantee it due to compliance, but I think you're going to be glad that you listen to what I had to say. So we're going to take a quick commercial break, and then we're going to keep going on why your investment returns are not great. And again, the hint, it's not fees. Don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. We're going to get into what Morningstar found in 2025. So, right before the commercial break, I gave you some homework items. And I want to dive more into the research itself because this is where it starts to get interesting, because up until the commercial break, yes, there were a lot of things I told you that you probably knew, but I wanted to give you more anecdotal research backing behind it. But this is more into what Morningstar found in order for you to not have bad investment returns and maybe, again, compliance, maybe have superior investment returns. So what they found one of the big things that they found, was the more deviation, that could lead to more trouble. So what does that mean? The funds that they analyzed that strayed far from their benchmarks tended to have larger investor return gaps, which makes sense. If you have an index fund or an ETF, and it's an index fund that tracks the S&P 500, well, you're going to earn whatever the return of the index fund was, or the index was, minus whatever the expense ratio is. I mean, it's pretty cut and dry. And then you've got a lot of these people out there, and we call them closeted indexers, where they're managing this fund and they give you all these beautiful marketing material, yada, yada, yada. But then when you look at it, it's really just an index fund, but they're getting paid to supposedly do a little bit more. And a lot of these people out there that that manage these funds, unfortunately, I don't think this is right at all, but this is just the way the world works. You're kind of pressured to mirroring whatever index is. And the S&P 500 is the most popular one out there. I'm not saying it's right or wrong. It just is. So you got a lot of fund managers out there that are trying to get around the same return as the S&P 500. And that's not necessarily the right thing to do. So if you do have more deviation from the S&P 500, it's like a standard deviation curve. You could do really, really well, like above and beyond, or you could do really, really bad. But if you have a business mind and a true professional investment mind, just because you have a bad year, that doesn't mean your portfolio is bad. That just might mean the emotions of everyone else investing in it are flawed. And one man's trash is another man's treasure. Same thing with investing. Now, another thing that Morningstar found, which was interesting, was high trading activity led to wider gaps, meaning the more investors transact, the more performance they lose. And again, for everyday people, we talked about that from a tax standpoint, but even with like professional fund managers that say, hey, we're trading actively on an ongoing basis, and, we have a lot of activity in our portfolio. Well, you're no different than everyone else. The more you trade, frankly, the more you lose, not only from taxes, but transactional costs. So if you're looking to work with a planner or an advisor out there, and they're giving you the spiel of how much they trade to have active share and all this, it's frankly bullcrap. And it's probably going to cost you in the long run. Sometimes the best action is no action at all, hence the free piece of advice. And another piece of info that the study found was ETFs versus mutual funds. Exchange traded funds, ETFs for short, showed wider return gaps, especially in international in sector-focused equity funds, which suggested that there was a misuse and overtrading despite the tax advantages that ETFs have. So a lot of people in our industry, they kind of just blow where they go where the wind blows. So right now, index funds are the hottest things in sliced bread, and they have been for a while. And, there can be some decent, there's decent data backing it. But again, that doesn't mean that just because the data backs XYZ, it's right for everyone. And it doesn't mean it's going to be as right as it is forever. People forgot that in the 80s and 90s, Japan, the Nikkei 2000, that was the place to go when it came to investing, because Japan's economy was just sky high. I mean, it was ripping. Well, Y2K comes around, and up until really 2024, Japan's economy has done nothing. It's just been in deflation, just a free fall. So, a lot of these people, they go, hey, we're going to lean into the index fund side of things, and that's just the absolute right thing to do. Well, just because you're investing in index funds, again, the research has shown that doesn't mean that you're suddenly going to have this magical return and just match whatever it is the S&P 500 does. And even if you are invested in the S&P 500, that doesn't mean that the S&P 500 is going to continue to do what it has done. The United States has a lot more to it than like a country like Japan. That's a whole nother story. But, the United States, they're not invincible. No country is invincible. Also, here's another crazy thing. There are more ETFs than out right now than publicly traded companies. That's crazy. That is absolutely crazy to me. So, really what it's saying is, and again, I'm not trying to become like just, oh my gosh, I'm knocking on ETFs and I'm all in on mutual funds. What I'm saying is ETFs are not necessarily what they are cracked up to be. Index funds are not necessarily what they're cracked up to be. Mutual funds are not necessarily as bad as what people are thinking. And you just need to understand the research to it. Okay. And there's a couple additional insights that I want you guys to take away. So one, simplicity wins. And I hate saying this, but I'm going to say it. Investors in allocation funds like a target date fund or a balance fund, which again, I hate those. I cannot stand them. They're so bad. If anything, I would rather have a balance fund over a target date fund. If you've listened to the show, go back and listen to the previous episodes, and I rant about that forever. But it's interesting because investors that invested in these funds, they actually did better than people trying to time things. So what I'm trying to say is, yes, simplicity wins. It's better than nothing. You can take that away from the research that Morningstar provided. Even though I'm not a fan of targeted funds in particular at all. I think they are just they're the devil's work. I know people are going to be like, oh my God, this guy is absolutely asinine for saying that. I don't care. I really don't care. I'm going to keep saying it till I'm blue in the face. Because we know target date funds and balance funds by definition will not perform as well over time. Another insight I want you to take away, niche strategies like specific sector investments saw the worst gaps. Okay, so if they did really, really good, they did really good. But if they did bad, they did horrid. And normally the reason for that was due to just timing on certain things. We do know that automation helps. All-in-one solutions can make it easier to stay invested and reduce emotional decisions. But again, we talked about this earlier. You still want to be actively involved, even if things are automated, and set and forget. Another major takeaway, be conservative. Add a margin for error in your return forecast when planning, or really just in general, but specifically spending or saving and investing. Now, this does not mean be traditionally conservative or aggressive in your investment planning. That's something I've discussed for years about on this show. And I write about it extensively in my first book. When you invest on the emotional unintelligence of money, you are going to set yourself up for failure. But you want to be conservative in that regard that I just mentioned. And another thing that I want you to think about is costs are not everything. And even though cheaper funds tend to have smaller return gaps, even passive investors mistime their trades, meaning index fund investors, S&P 500 investors, they mistimed their trades, sometimes worse than active investors that get just absolutely dumped on all the time because it's easy, because that's just groupthink 101. And one thing I want you to take away before we close out with my final thought. So there was some rethinking about risk and reward. And there were two things I wanted to mention. The research challenged the idea, and I mentioned this a couple minutes ago, but it needs its own little segment. Higher risk always equals higher reward. According to the research, that is not true at all. So get that out of your mind. And the second thing is volatility doesn't automatically lead to better outcomes. More volatile funds can underperform if you are trading poorly. So what does all of this mean? My final thought before we close this episode out. It's not just what you invest in, it's how you behave as an investor and as you're planning within your own plan that determines your true, real return. So that does it for today's episode. As always, I'm your host, Christopher A. Poniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris@capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Poniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The S&P 500 is a stock market index tracking the stock performance of 500 of the largest companies listed on stock exchanges in the United States. Indexes are unmanaged and cannot be invested indirectly. An asset allocation strategy does not ensure a profit or protect against loss. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. For investing, carefully consider a target date fund, balanced fund, index fund, or exchange-traded mutual funds investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Target date funds are subject to the volatility of the financial markets, including equity and fixed income investments in the U.S. and abroad, and may be subject to risks associated with investing in high-yield, small cap, and commodity-related foreign securities. Principal invested is not guaranteed at any time, including at or after target dates. Index funds do not protect you from market ups and downs. Some index funds may have concentrated holdings. Index funds do not shield you from business or governance risks. In prolonged downtrends, index funds can perform poorly. Indexes are set portfolios, limiting flexibility. ETFs used trade like stocks are subject to investment risk, fluctuate in market value, and may trade at prices above or below the ETF's net asset value. Upon redemption, the value of fund shares may be worth more or less than their original cost. ETFs carry additional risks such as not being diversified, possible trading halts, and index tracking errors. Investments in real estate may be subject to a higher degree of market risk because of concentration in a specific industry, sector, or geographical sector. Other risks can include, but are not limited to, declines in the value of real estate, potential illiquidity, risk related to general and economic conditions, stage of development, and defaults by borrower. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Rebalancing a portfolio may cause investors to incur tax liabilities and / or transaction costs and does not assure a profit or protect against a loss. Stock investing includes risks including fluctuating prices and loss of principal. Christopher Poniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. The people and / or companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances.